Welcome to an investment update with Generate. I'm Stephanie, one of the advisors here, and I'm here with Nathan Field, our Global Equities Portfolio Manager. Welcome, Nathan.
Thank you.
So tell us, last month you were in New York at one of the, two big industry conferences. What was your takeaway from that?
Yeah, so two conferences I went to. The first one was a 3-day technology conference, and that was followed by a 3-day financial services conference. So two very different sets of companies, saw over 50 companies in total, and it brought a very wide range of opinions and perspectives on the US economy. On the technology conference, obviously the hot topic was AI, and every company I saw was leaning into that technology, whether it's building new custom chips or data centers or improving their software to offer AI features or functionality. There's a lot of innovation going on, a lot of investment, and a lot of excitement. So, we don't think AI is a fad or a bubble by any stretch of the imagination. This is going to be at the core of technology for many decades to come. But outside of AI, it wasn't all good news in the technology front. Your general everyday spending on IT was actually a bit sluggish in 2024. Some of that's due to the economic cycle, and some of it's due to some uncertainty ahead of the US presidential election. People don't want to plan too far ahead when they don't know what the outcome will be. But there is some optimism about that spending rebounding next year. On the financial services front, I was very surprised at the upbeat mood. These are banks, credit agencies, other financial institutions, and the banks especially were quite upbeat. They're not seeing any problems in credit or delinquencies, which you might expect given interest rates have been so high for so long. And there's some optimism going into next year because interest rates are now falling, which should be good for mortgage demand and corporate lending. So overall, yeah, it was a positive take on the state of the US economy. Things can change very quickly, but as things stand today, the US economy is in good shape.
So how are you feeling about the US presidential election upcoming and the impact on the market?
I'm feeling it's going to be very close. 3 months ago, it looked like Donald Trump was going to be a shoo-in, and then Biden stepped down and Kamala Harris breathed new life into the Democratic Party, and she became favourite for a while. As we stand today, it's too close to call. It's neck and neck. So it is going to go right down to the wire. In terms of investment implications, look, we're not making any investment decisions based on who might be in the White House, simply because we don't know, and I don't think anyone does. But it's fair to say that the market cares less about who's in the White House than many people think. In 2016, when Donald Trump won the presidency, the markets went up. In 2020, when Joe Biden won, markets went up again. There's no guarantee that would happen this time around, but it's a good argument that markets hate uncertainty more than anything else. So once this election is over and we know what the outcome is, companies can get on with their forward planning and making money. So it will just be good to get this election out the way.
Right, yeah, we'll be watching. So I'm hearing a lot about the recent Chinese share market rally after the government announced new policies to boost the economy. Do we invest in China? And do you think this is the kickstart the economy needs?
China came out about 10 days ago with a comprehensive monetary policy stimulus package designed to lower borrowing costs for households and improve credit demand. Now, it was a more comprehensive package than the market was expecting, and investors certainly took notice, and the Chinese stock market underwent the biggest week-long rally that we've seen in more than a decade. It remains to be seen whether this is enough to kickstart the Chinese economy, but it has been a sleeping giant for many years now, and the share market has performed poorly. So there's a lot of upside there if the Chinese government gets it right this time and the economy does show signs of life. We don't invest in any Chinese listed equities directly, but we do own a couple of Hong Kong listed stocks which have a big part of their operations in China. And we also bought back into Alibaba, which is basically the Chinese Amazon with a listing in the US. Now, that stock rose 30% very quickly, but it's still 60% below its all-time highs. And that really illustrates the upside that's available in the Chinese market if this package is enough to get things moving again. So yeah, too early to say, but certainly things look a little more promising today than they did 2 weeks ago.
Thank you, Nathan.
Thank you, Stephanie.
Thanks for watching.